If you've ever traded options, chances are you've heard of the iron condor, a favorite among traders who want to profit in quiet, sideways markets. An iron condor involves selling an out-of-the-money call spread and an out-of-the-money put spread, all on the same underlying asset and expiration date. The goal is to keep the asset's price within a certain range so that all options expire worthless, and you keep the net credit received. But markets don't always behave. Prices can break out of that range, and when they do, your strategy needs to adapt. That's where rolling comes in. Rolling means adjusting your current iron condor, usually by closing it and opening a new one with different strike prices, a later expiration, or both. It's a tactical move to manage risk, improve your chances of profit, or simply buy more time. Why roll instead of just closing the trade? Because rolling lets you extend your timeline, giving the trade more room to work. You can adjust your strikes to match current market conditions and stay in the trade while managing potential losses. Let's break it all down. How to roll an iron condor when it makes sense, and the pros, cons, and common mistakes to avoid. At its core, an iron condor is a neutral strategy. You're not betting on the market going up or down, you're betting it won't move much at all. Here's what the setup looks like. You sell a call above the market and buy another one further out to cap your risk. On the put side, you sell a put below the market and buy a lower one for protection. That creates a defined range where you want the underlying to stay. Your best case scenario? The price stays inside that range, all options expire worthless, and you keep the full credit. Worst case, the price breaks through either wing and you face a limited but real loss, equal to the width of the spread minus the credit received. So, when do you adjust? When the price starts creeping toward or past one of the short strikes, if volatility spikes and you expect bigger swings, or if you simply want to reposition the trade for a better outcome. Timing is everything. If the underlying asset's price starts heading toward one of your short strikes, that's a red flag. You might be at risk of a max loss if the move continues. Here are a few signs it's time to consider rolling. If one side of the condor is gaining too much directional exposure, if your loss exceeds a set threshold, or if key support or resistance levels break. But before you act, take a step back. Look at the bigger picture. Time decay works in your favor, as long as the price stays within range. But if you're nearing expiration and the trade's under pressure, rolling to the next cycle might be the right call. Implied volatility also matters. If it's high, closing losing legs is more expensive, but you'll also collect more premium on the new trade. And don't forget market context. Earnings, news events, and broader trends can all impact your next move. Rolling isn't about avoiding every loss, it's about staying in control and giving yourself more ways to win. So how do you actually roll a condor? Start by assessing your current position. Where is the price relative to your strikes? Is one side threatened? What's implied volatility doing? How much time is left until expiration? Next, choose your rolling strategy. You can roll just one side, move the calls up or the puts down, depending on where the pressure is. You can roll the entire condor to a later expiration, keeping the same strikes but giving the trade more time. Or you can widen the wings, increasing the distance between the short and long strikes to reduce max risk. Just know that might lower your total credit. Once you've decided, here's the process. Close your current position by buying back the short options and selling the long ones. Open your new position with updated strikes or expiration. Check the net credit or debit. Ideally, you want a credit or a manageable debit that fits your risk profile. Make sure your account has the margin to support the new trade. Then confirm and place the order. Rolling isn't about fixing a bad trade. It's about adapting to the market with a clear plan. Now let's look at the pros and cons of rolling an iron condor. On the plus side, rolling lets you manage risk by shifting strike prices or widening your spreads. It gives you more time to be right, especially useful in choppy or mean-reverting markets. You may collect more premium when rolling for a net credit, and overall it gives you more flexibility and control over the trade. But there are trade-offs. You'll face increased transaction costs. 4 legs in, 4 legs out, commissions and slippage add up. Rolling can delay losses but also make them worse if the new trade goes south. It can tie up more capital, especially if you're widening spreads or pushing expiration further. And perhaps most importantly, it can become a psychological trap, rolling just to avoid admitting a losing trade. That's not strategy, that's emotion. And finally, let's cover a few common mistakes to avoid when rolling. First, don't roll too early or too late. Rolling too soon can cut off potential profit. Rolling too late can make the adjustment too costly to be worthwhile. Second, don't ignore trading costs. Every roll includes 8 total option legs. If you're not careful with execution or using illiquid underlyings, the cost can eat away at your returns. And third, always consider your overall portfolio. One adjustment might fix a position, but increase your risk elsewhere. Don't become overexposed in one direction or expiration. Rolling an iron condor is a powerful tool, when used wisely. It's not a magic fix, but with a clear plan, good timing, and smart risk management, it can keep your trades alive, improve your odds, and give you an edge when markets don't cooperate. Roll with purpose, stay flexible, and always know your why.